Have you ever looked at your retirement account balance and thought, this should feel like more? You've been doing it right, contributing every month, diversifying, following the rules, and the number keeps going up. But somehow, deep down, you know something doesn't add up. Because while your 401k statement says you're on track, your grocery bill is screaming something different. Your rent is screaming something different. The price of everything is screaming something different. And then your brain does that thing where it starts asking the uncomfortable questions. Am I actually prepared? Is everyone else seeing this? Here's the part nobody tells you. It's not that you're bad at planning, it's that the rules quietly changed. Welcome to Ben's Money Milestones, where late starters build real wealth. Okay, so just quickly before we get started here, let's be clear about what we're talking about. This isn't about market crashes or recession fears or whether stocks go up or down next quarter. This is about something structurally different, a change in how money itself works. And your retirement plan was built for a game that's ending. Look, I've spent the last 3 months reading documents most people will never see. SEC filings from the world's largest hedge funds, IMF working papers on currency transitions, Bank for International Settlements reports that are literally 800 pages of economic jargon that nobody reads. And what I found is this. The financial system isn't heading into a normal downturn. It's heading into a transition, the kind that happens maybe once or twice a century. And most people won't realize it happened until it's too late to adjust. So in the next 16 minutes, I'm going to walk you through the actual mechanics of how this works, why every warning sign is flashing red right now, and what this means for anyone trying to retire in the next 20 years. Because here's the thing, the psychology of money isn't about picking stocks, it's about understanding which game you're playing. And right now, most people are still playing a game whose rules changed. Let me explain how this actually works using something we can keep coming back to. Think of the global financial system like a lease, a massive commercial lease. After World War II, the world basically signed a lease with the United States. The terms were simple. The US dollar would be the global reserve currency. Everyone would trade oil, goods, debt in dollars. In exchange, the US would keep the currency stable, keep inflation low, and provide security to keep trade routes open. That lease has been running for 80 years. But here's the problem with long leases. The landlord starts taking liberties and the tenants start looking for other apartments. The first liberty the US took was in 1971. Nixon closed the gold window. That was the moment the dollar stopped being backed by anything physical. It was just backed by trust. And for a while, trust was enough. The US had the biggest economy, the strongest military, and everyone needed dollars to buy oil. But trust is a psychological asset, okay? And psychological assets decay when you abuse them. Let's talk about abuse. The US national debt is now $36 trillion. That's 120% of GDP. To put that in perspective, if you made $60,000 a year but owed $72,000 on credit cards, your debt-to-income ratio would be the same as the United States government. Now, you might be thinking, okay, but we've had high debt before. True. Back then, after World War II, debt to GDP hit 106%. But here's what's different. Back then, the US had a young population, a manufacturing base, and it was a net creditor to the world. Now, the US has an aging population, offshored manufacturing, and borrows money to pay interest on money it already borrowed. That's not a debt problem, that's a Ponzi problem. And here's where psychology gets interesting. When you're running a Ponzi scheme, you have two options. You can admit it's a Ponzi scheme and restructure, or you can keep it going by finding new buyers. For the last 15 years, the Federal Reserve has been the buyer of last resort. Every time Treasury yields started spiking, meaning nobody wanted to lend money to the US government, the Fed would step in and print money to buy bonds. That's called monetizing the debt. It's also called inflation. But that trick only works if the rest of the world still needs dollars. This is where it gets really interesting. The second sign of a dying monetary system is what economists call the big cycle of internal disorder.
Basically, when wealth inequality gets extreme, societies fracture. The data on this is wild. In 2024, the top 1% of Americans held 32% of all wealth. The bottom 50% held 2%. That gap is wider than it was in 1929, right before the Great Depression. Now, inequality alone doesn't break a system, but it creates the conditions for political instability. And political instability makes people nervous about holding long-term government debt. If you think a country might have internal conflict or a government that defaults on obligations, you don't want to lend that country money for 10 years at 3% interest, right? So what do you do instead? You buy gold. You buy real assets. You move money into currencies that aren't tied to a politically unstable system. And that's exactly what we're seeing. Central banks around the world bought over 1,000 tons of gold in 2024. That's the second highest year on record. China, Russia, India, Turkey, they're not buying gold because they think it's pretty. They're buying it because they're quietly exiting the dollar lease. Now you might be thinking, but countries have been predicting the death of the dollar for decades. It never happens. Fair points. But here's what's different this time. The third force is geopolitical conflict, external disorder. And right now, we're seeing the most significant realignment of global power since the end of the Cold War. Russia invaded Ukraine and got kicked out of the SWIFT system. That's the global messaging network for payment transfers. That was supposed to cripple them. Instead, Russia started settling trade with China in yuan and rubles. China and Brazil cut a deal to trade in their own currencies. India is buying Russian oil with rupees. The Gulf states, who have priced oil in dollars since the 1970s, are now talking openly about pricing in multiple currencies. This isn't a theory. This is happening right now. And here's the kicker. When you weaponize the dollar, you teach the world to build a financial system that doesn't need the dollar. That's not a conspiracy. That's an incentive. If I can lock you out of the payment system because I don't like your foreign policy, you're going to build an alternative payment system. And once that alternative exists, everyone who's nervous about being next in line starts using it too. It's the same psychology as a bank run. The bank doesn't fail because it's insolvent. It fails because people think it might be insolvent, so they pull their money out, which makes it insolvent. Self-fulfilling prophecy. Now, let's get concrete. Let me show you what this looks like for an actual person. Meet David. He's 42. He's got $350,000 in his 401k, all in a target date fund. He makes $110,000 a year. That's solidly middle class. He's contributing 6% of his salary, his employer matches 3%. According to every retirement calculator he's used, he's on track to retire at 65 with $1.8 million. Sounds great, right? Except that math assumes three things. It assumes 7% average annual returns, it assumes 2.5% inflation, and it assumes the dollar he retires with in 2016 buys roughly the same basket of goods as the dollar he retires with in 2049. Here's the problem. If we're entering a period of monetary transition, all three of those assumptions break. Let's say the US government, facing a debt crisis and unable to find buyers for treasuries, decides to let inflation run hot to erode the real value of its debt. That's not speculation. That's what every country in history has done when it couldn't pay its bills. If inflation averages 5% instead of 2.5% over the next 27 years, David's $1.8 million in retirement only buys what $800,000 buys today. He just lost $1 million of purchasing power and he doesn't even know it yet. His statement still says $1.8 million, but the game changed underneath him. And it gets worse, because if the dollar loses its reserve currency status, U.S. interest rates have to go up to attract buyers for government debt. Higher interest rates mean lower stock valuations. The S&P 500 is priced for an environment where the U.S. can borrow cheaply forever. If that assumption breaks, we're not talking about a 10 or 20% correction. We're talking about a repricing of every financial asset in dollar terms.
David's target date fund, which automatically shifts to bonds as he gets older, would get destroyed. Bonds lose value when interest rates rise. That's not a prediction, that's math. Now, to be fair, this doesn't happen overnight. Monetary transitions take years, sometimes decades.
But here's the thing about slow-moving disasters. People don't adjust their behavior until it's too late. It's the same psychology as climate change or smoking. You know it's bad, but it's not bad today, so you don't change anything. And then, one day, it's bad and you can't undo 20 years of compounding mistakes. So what does the US do? It has two options. Option one is to fix the underlying problems, cut spending, raise taxes, get the debt under control, rebuild trust in institutions. But that requires political will, and political will requires short-term pain for long-term gain. And in a democracy where elected officials are optimizing for the next election cycle, not the next generation, that's not going to happen. So option two is to change the rules of the game, and this is where it gets weird. There's a real possibility that the US moves to some form of commodity-backed currency, not a full gold standard, but something like issuing treasury bonds backed by gold reserves. Some economists have openly called for this. The idea is that if you back the dollar with something tangible again, you restore trust and bring countries back into the dollar system. The US supposedly has 8,000 tons of gold in Fort Knox. At current prices, that's worth about $630 billion, which sounds like a lot until you realize the US national debt is $36 trillion. You'd need to revalue gold at over $40,000 an ounce just to cover 10% of the debt. And if the US doesn't actually have the gold it claims to have, which has never been audited in any meaningful way, the whole plan falls apart. Or maybe the US pivots to a digital reserve system. Bitcoin is already being accumulated by nation-states. El Salvador made it legal tender. The US reportedly holds over 200,000 Bitcoin seized from criminal enterprises. If the US announced a strategic Bitcoin reserve and started issuing bonds backed by Bitcoin, it would legitimize crypto as a reserve asset overnight. But here's the problem with all of these solutions. They require coordination. The US can't unilaterally declare a new monetary system and expect the world to follow. After World War II, the US could do that because Europe was in ruins and needed dollars to rebuild. Now, China has the second largest economy in the world. The European Union is a massive trade bloc. India is rising. These players have options, and if they don't like the new rules, they'll just build their own system. Which brings us back to the lease metaphor. When the lease is up, the tenants don't have to renew. They can move out. Now, here's what most people get wrong about this situation. They think it's this dramatic event. One day you wake up and the dollar is worthless and we're all using gold coins. That's not how it works. It's a slow grind. It's your grocery bill going up 5% a year instead of 2%. It's your bond fund underperforming. It's the slow realization that the retirement you planned for isn't the retirement you're going to get. And by the time you realize it, you've lost a decade of compounding you can't get back. Major hedge funds have been screaming about this for years, firms that manage over $100 billion. These aren't people making bets based on vibes, okay? They model this stuff using data from the last 500 years of empire cycles. And every model says the US is past its peak and entering the decline phase. That doesn't mean collapse, it means transition. And transitions are messy. So let me tell you what this actually looks like in practice, what you can do about it. And I want to be clear, I'm not a financial advisor. This is what makes sense based on research and what the data is showing. You need to do your own homework. First off, diversification out of purely dollar-denominated assets. That doesn't mean selling all your stocks, it means holding some gold, some real assets, and yes, potentially a small position in alternative assets like Bitcoin. Not because Bitcoin is definitely the future of money, but because if there's even a 10% chance it becomes part of the global reserve system, the upside is asymmetric. Here's what a more protected allocation might look like. Around 40% in US stocks, but tilted toward companies with international revenue. 20% in gold, split between physical gold and gold ETFs. 15% in real estate, 10% in international stocks, specifically emerging markets that aren't tied solely to the dollar, 10% in alternative hard assets, and 5% in cash for opportunities. Second, shortening duration on fixed income. Long-term bonds are a terrible bet right now. If rates go up, you lose. If inflation stays high, you lose. Better to hold short-term treasuries or even cash and wait for clarity. Specifically, treasury bills with maturities under a year and I-bonds that adjust for inflation. Third, investing in skills and businesses that aren't denominated in any currency. The value of what you can do or build doesn't change just because the monetary system does. Learning how to build actual businesses that generate cash flow, investing in skills like coding, writing, anything that creates value, because if currencies fail, skills don't. Fourth, and this is crucial, paying off high-interest debt but keeping low-interest mortgages. Here's why. If we get inflation, your mortgage payment stays the same while your income theoretically goes up with inflation. You're paying back the bank with cheaper dollars. That's strategic use of leverage. But credit card debt at 20% interest, that's just destructive in any environment. Pay that off immediately. Fifth, building relationships and community. This sounds soft, but it's not. In every monetary crisis in history, the people who did well weren't just the ones with gold. They were the ones with networks, with people they could trust, with skills they could trade. Social capital becomes more valuable than financial capital when systems break down. Now, let me address the elephant in the room. What if this is wrong? What if the US figures this out and we get another 50 years of dollar dominance? Well, here's the beautiful thing about the strategy I just outlined. You're not worse off. Gold might underperform for a while, but it's insurance. Bitcoin might crash, but it's a small percentage of a portfolio, not 100%. Real skills and businesses, those are valuable regardless. Diversification across asset classes and geographies, that's just good sense in any environment. The cost of being wrong about a collapse is underperforming the S&P 500 by maybe 2% a year for the next decade. The cost of being wrong about everything being fine is losing 50% of purchasing power and not being able to retire. Those aren't symmetrical risks. Here's what you can do in the next 30 days. Week 1, audit your current portfolio. Write down everything you own: stocks, bonds, real estate, cash, retirement accounts. Calculate what percentage is in dollar-denominated assets. If it's over 80%, you're overexposed to one currency. Week 2, open accounts you don't have yet. Find a reputable gold dealer. Open an account at a crypto exchange if you're considering alternatives. Look into international brokerage accounts. Week 3, make your first diversification move. Don't try to rebalance everything at once. Start small. Buy 1 ounce of gold. Put $500 into an alternative asset. Just break the psychological barrier of owning something other than dollar assets. Week 4, set up a monitoring system. Pick 3 indicators to watch every month: the 10-year Treasury yield, the price of gold, foreign exchange reserves held by major central banks. When those move significantly, it's time to reassess. And look, maybe this is wrong. Maybe the US figures this out and we get another 50 years of dollar dominance. But the data says otherwise, and it's better to be early than late. Here's the thing people don't understand about monetary transitions. The cruel irony is that the people who get hurt the worst are the ones who did everything right. They saved money, they maxed out their 401k, they bought index funds. They believed the system would reward patience and discipline, and it did for 80 years. But the system is changing, and if you don't change with it, you're going to wake up at 65 with a number on a screen that doesn't buy what you thought it would buy. The lease is up, the tenants are moving out, and if you're still sitting in the apartment assuming everything will be fine, you're going to be the last one left when the rules change. The game isn't about being smart, it's about understanding which game you're playing and when the rules change. Most people are still playing the game from 1985. Low inflation, stable dollar, bonds as a safe haven, stocks go up over time. That game is over. The new game has different rules, and we're all figuring them out in real time. Don't be the last one to figure it out.